What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In 2020 and 2021, we've seen an unprecedented number of SPACs which have inundated the market with new stocks. In the past 2 years alone, there have been more than 500 companies that have gone public via SPAC. The idea of SPACs is to give individual investors access to early-stage high-growth investment opportunities. Unfortunately, there simply aren't enough high-quality private companies to support the unprecedented number of SPACs. This has led to some really questionable companies going public, many of which would not have passed the due diligence processes of a traditional IPO. This histogram shows the performance to date of all SPAC deals closed in 2020, as compiled by SPACtrack.net. All of the SPACs to the left of the red vertical line have a negative return and are currently trading below their initial price of $10. 56% of these SPACs have lost money for investors. However, the distribution is heavily right-skewed, with a few SPACs having astronomical returns. The single best performer was DraftKings, which has risen almost 300%. The few big winners pull up the average significantly, so the average returns of these SPACs is 20% today, which is pretty good. But if you looked at SPAC deals which closed in 2021, it's a very different story. 64% of this cohort now sit at below the initial price of $10, and the average return is negative 8%. The SPAC deals from 2021 have underperformed the 2020 SPACs by a margin of 28%. By 2021, most of the good companies like DraftKings had already gone public. This has led to a situation where SPAC sponsors have to dumpster dive and acquire low-quality companies just so they can collect their fees. In this video, we'll be looking at 5 of the craziest examples of questionable companies that were acquired by SPACs at absurd valuations over the past 2 years. The first entry on our list is AppHarvest, which went public via SPAC in September of 2020 with a roughly $1 billion valuation. It has since declined 45% to $5.55 per share. At the peak of the SPAC mania in February, its share price reached $35, giving it a valuation in excess of $3.5 billion. So what were the investors getting for their $3.5 billion investment? Is it some sort of innovative software or electric vehicle company? It's actually an agricultural company that produces tomatoes in their Kentucky farming facility. In 2021, they had only one active 60-acre farm. They expect this farm to generate about $8 million of revenue and incur a loss of $70 million before even accounting for depreciation, amortization, and share-based compensation. This means that the company is currently trading at almost 70 times their 2021 revenue guidance. At their peak in February, they were trading at more than 400 times revenue. To put this into perspective, many people thought that Snowflake's valuation was insane when they IPO'd at 100 times revenue. At its peak, AppHarvest had a valuation more than 4 times greater than that, despite the fact that they produced tomatoes, not software. They tried to justify their insane valuation by saying their greenhouse is more high-tech and can produce a greater production yield than traditional farming. While this might be true, their greenhouses are extremely expensive to build and operate, leading to their massive cash burn. It's unclear whether or not they'll be economically viable at scale. One of the reasons that investors bought into the company is because they are extremely bullish 5-year projections. In December of 2020, they said they expect to make $21 million of revenue in 2021, and by 2025 this would explode to almost $500 million. The problem with these types of projections is that there's so much uncertainty about the future, and companies often err on the side of optimism to help push up the stock price. As it turns out, AppHarvest later reduced their 2021 revenue estimate by more than 50% to $8 million, as their farm did not perform as expected. Given that they overestimated their 2021 revenue by more than double, it's hard to have any confidence in their 2025 estimates. At the end of the day, AppHarvest is a tomato company, not a tech company. Just because it went public via SPAC doesn't change anything. Next on the list is Momentus Inc., which announced its intention to merge with a SPAC in November of 2020. It initially got a lot of hype from investors, and more than doubled to $25 per share within the first few months of trading. They purported to be a high-tech company that produces infrastructure for the growing space economy. One of the biggest bull arguments for the company was their advanced propulsion technology, which they claimed to have successfully tested in space. As it turns out, this claim was false and misleading.
Immediately
hasn't moved enough.
Do you see, this is direct response to my 17 different attacks on
Our
him.
viewers may remember Stable Road acquisition. It was only last week. They cut the price that they were paying for this Momentus basically in half, a satellite company. But the SEC has charged them and come after them in a big way this morning. They allege the company's misled investors about their technology, about national security risks. in terms of the former CEO.
Well, hold on, Dave. Come on, give the best line.
Go ahead.
Investors have been told that it successfully tested its propulsion technology in space, when in fact the company's only in-space test had failed to achieve its primary building.
Basically, they misled investors about the technology, and eventually had to settle a lawsuit with the SEC and replace their CEO. Surprisingly, the stock price is still above the initial SPAC price of $10, despite these issues. Next off, we have Metin EdTech X Education Group, which listed via a SPAC in April of 2020. This company is notable because it has experienced the worst performance of any SPAC in all of 2020 and 2021, with its share price down almost 98% to date. Its share price of 42 cents gives it a market cap of just $41 million, putting it squarely in the penny stock category. The company operates an online English teaching platform in China. In September of 2021, the Chinese government banned all private tutors from giving online classes. This essentially outlawed METX's entire business model. This is one case in which the company didn't necessarily do anything wrong, such as mislead the investors. They just got unlucky with China's unpredictable regulatory environment, and investors ended up losing everything. Next, we have another Chinese SPAC, which has had almost equally terrible performance. Commune International merged with a blank check company in November of 2020. The share price almost immediately started free-falling, and it now sits at just 97 cents, down more than 90% from the initial price. Founded in 2015, Commune is a flexible office space provider. You can basically think of them as the WeWork of China. And their financial results were also very similar to WeWork. In the first half of 2021, they made $78 million of revenue. Their cost of goods sold was $82 million, or slightly higher than their revenue. That means that they had a gross profit of negative $4.5 million. While it's normal for high-growth companies to lose money in the beginning, having a negative gross profit is on a whole different level. They were subleasing the office space for below their own cost. You can think of this as equivalent to selling $100 bills for $96. After subtracting their operating expenses, they made an operating loss of $49 million, or more than 60% of their revenue. It turns out it's very difficult to make money renting office space and subleasing it to tenants. And based on their financials, it appears that their business model was never viable. You would think that investors would have learned their lesson after WeWork from 2019, where venture capitalists lost close to $10 billion. But inexplicably, investors approved the Commune SPAC and almost immediately started paying the consequences.
It fooled me, we can't get fooled again.
To round out the list, we have Owlet Baby Care, which has declined more than 60% since its SPAC listing this past July. They create baby monitoring systems such as a crib camera and a smart sock, which new parents can use to monitor their baby's health. While their products seem to be pretty good, the main problem was their absurd valuation. In the first half of 2021, they generated $47 million of revenue, which is 41% above the prior. However, their operating loss also exploded by 248% to $8.7 million as they massively increased their spending on sales and marketing. Any company can grow its revenue if it just increases its marketing budget, but they have yet to prove they can make a sustainably profitable business. And with a 2021 revenue run rate of about $100 million, it seems difficult to justify their SPAC valuation of more than $1 billion, given how niche their baby care products are. The 5 SPAC disasters that we've covered in this video should serve as a cautionary tale to anyone who is considering investing in SPACs. SPACs are much more prone to fraud than traditional IPOs, and often list at inflated valuations. What do you think about SPACs on this list? Are there any other SPACs that you think we should have included? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.